Welcome to this Energy Quick Chat where we rub minds with stakeholders and players in the energy market. Now, crude oil prices have seen some major shakeups in the past few days due to cross-border crisis in the Middle East, shutdown of the Libya's top oil field, that's the Sharara, and shippers complaining of higher costs. To give more context to this is Julien Mathonniere and share his outlook for 2024. He's an oil markets economist at Energy Intelligence. Julien, it's good to have you here on Energy Frontiers.
A very good day to you, Justina. Thank you for having me.
Right. So let's dig right into it. What's your outlook for 2024 and what major trends do you see shaping the global oil and gas market?
So in a nutshell, we see oil demand dropping back to their historical sort of level, which is around 1 million barrels per day. As the post-COVID rebound ends and economic pressures take their toll everywhere. We still see some support a little bit for jet fuel, some post-pandemic air travel and LPG and naphtha for petrochemicals feedstock. We also see a strong non-OPEC supply plus still going on. It looks set to continue in 2024, driven by the US, by Brazil, by Guyana, a bit by Canada as well. So we expect 1.5 million barrels per day of growth from non-OPEC plus, including 1 million barrels per day of crude alone. And this combination should keep prices in the $75 to $85 per barrel range. And this leaves limited room for OPEC plus, the core OPEC group and their allies to unwind their cuts, the cuts they've done since October 2022. So I think the demand trajectory for oil will be key this year. As for gas market, they should remain finely balanced, but risks remain. We still got geopolitical turmoil. We've got potential unplanned supply disruption, stepped up demand. If it increases, it presents potential risk. Europe, after a full year of sharply lower Russian gas supply, has managed to find LNG elsewhere. Cargoes coming from Asia to rebuild storage. And it's been helped by, a relatively mild weather and good, good demand policy, limiting the demand for oil. Markets will keep watching whether Europe keeps attracting, squeezing out the remaining Russian supply and attracting more LNG from elsewhere, ramping up supply alternatives, notably from Norway, Azerbaijan, etc., a little bit from Qatar. So that's the outlook in a nutshell.
Right. So how much of an impact are the Middle East crisis, attacks on vessels and Libya's supply complications having on these commodities? Put this into context for us.
Yes, of course. So I think, it seems to me that what matters is not so much sporadic events like, conflicts, wars or terrorist attacks, but longer term, geopolitical trends. Attacks against Israel-linked vessels in the Red Sea have continued, but you can see that Brent prices are struggling to retain their $4-5 per barrel price premium. What matters, however, is the rising fragmentation in commodity markets. And the measures restricting trade in the long term. Some trade routes are becoming longer and suboptimal, which increase the cost of doing business. As the Red Sea events reminds us, prices are more volatile because adjustments are more frequent and they're more sudden, and commodity markets, as a result, are more fragmented. And as for supply disruptions in Libya, they followed the shutdown of the El Sharara oil field. And they essentially prompted refiners, especially in the Mediterranean, to secure alternative supply just in case it lasts or just in case something more serious happens. So, they've been buying more US oil because it's very similar. I mean, it's sort of similar to Libyan oil. It's light and sweet. And they want to mitigate any potential and lasting Libyan crude export shortfall, And if Libyan disruption lasts, then it will probably make OPEC project to return more supply to the market even more difficult. They're going to struggle with that. We'll get to that in a minute.
And I hope we don't get to that point, because having to do a journey that used to be 2 days or less, and you have to do a turnaround in order to be able to deliver some of these oil productions, it can be very daunting. So what should be done to mitigate these headwinds, to normalize supply and keep oil prices in the balance?
Well, our view of energy intelligence is that production capacity really is not a problem. In fact, OPEC is now faced with the opposite dilemma of having too much supply, too much of it. And you've got adequate spare capacity. We've got more than 5 million barrels per day into the system that can be used. A lot of it in Saudi Arabia, of course. We've got large oil inventories in China, which can serve to cap prices, to limit any price uptick, serious price uptick. And, even if OPEC's forecast of 2.25 million barrels per day of growth demand in 2024 sort of is realized, then I think that still rules out a major tapering of OPEC's and especially Saudi Arabia's current cuts in a fair and orderly manner. Because, as I said, we expect 1.5 million barrels per day of additional supply from non-OPEC. So the question is, how does OPEC do to return more supply to the market? How can they reverse the cut? It's going to be very difficult, and it's going to be very tricky math, with the quotas from other members. I think it's the biggest hurdle for OPEC coming.
To be some hurdle over there. So, how much of impact is Angola's exit? Speaking of OPEC, that is, how much of impact is Angola's exit from the OPEC alliance going to have on the country's oil production and exports to the international market?
Well, Angola has taken the decision to withdraw from OPEC after 17 years of membership. Angola has been underproducing by more than 300 barrels per day, 320,000 barrels per day exactly, owing to, major shortages in upstream investments, oil theft, aging infrastructure, etc. I don't think Angola's withdrawal from OPEC will change OPEC calculation a lot, since, they have consistently produced below their quota. In fact, I think what it means is that the underproduction from OPEC will probably improve in the coming month as a result of Angola's withdrawing, because they don't have to include the country in their calculation anymore. And as I said at the beginning, I think demand will be a key variable for OPEC supply strategy in 2024.
Oh, okay. So what should we be expecting from the OPEC Plus monitoring meeting on February 1, which is next month?
I think OPEC is going to have, as I said, it's about tricky mathematics. OPEC needs to enforce quotas discipline, and it's getting very difficult, as we saw from the Angola's case. I think OPEC is going to try to reverse the cuts, but in a very gradual manner. My understanding is that probably they will start by reversing the voluntary cuts, so the 2.2 million barrels per day, including a big voluntary cut from Saudi Arabia itself. And then after that, and only after that, they will start to revert the cuts, the commingled cuts from over OPEC members to avoid any, disputes within the group. But it's going to be very, very difficult to negotiate. And again, I think it's going to be a tricky year for OPEC.
Let's speak a bit about natural gas. We've seen a rally in that commodity recently. What's driving that rally and why?
I think, forecast for a genuine winter weather I've sort of sent natural gas futures soaring in the past few days. especially in the US, as well as in Europe to some extent, but especially in the US. And it's extending, as you said, the price rally for this commodity into the new year. I think the surging prices for prompt gases, that is for like, short-term immediate delivery, is due to those, weather forecast revisions with, colder temperature expected across the US as well as across Europe in the immediate, let's say 2-week period. And the fact that the market had not priced in winter so far. So suddenly winter is there. And if you want, it's more like a knee-jerk reaction, but it doesn't change the fundamental. Like from the perspective of the European natural gas market, the winter is already over. It's behind us. Half of the European heating season, is behind us. The weather has been relatively mild so far, except right now, but it's been relatively mild, which means that, supplies are plentiful. The current cold snap is just a blip. Even if it holds for the rest of the season, Europe would still consume far less natural gas than in normal winter. There is plenty left in storage, and there is a broad consensus on top of that inventories will remain high enough to limit any significant price pressure. So I think we're looking okay despite the recent price uptick.
I have more questions, but we have to leave it there right now. Julien Mathonniere, oil markets economist at Energy Intelligence. Thank you for speaking with us on Energy Frontiers.
Always a pleasure, Justina. Thank you so much for having me today.
Yeah, and that's it on our Energy Quick Chat on Energy Frontiers. Thank you everyone for watching. Make sure to comment, like, and subscribe to see more videos like this, and follow us across all our social media handles. Bye for now.